The other thing that is frightening is how little everyone is aware of how much it's going to cost when it gets to that age, and you're going to need the help for basic things, or sometimes people have more advanced care needs. So ranging from basic needs to advanced needs, how much that is going to cost you, regardless of whether you choose to stay in your home, whether you choose to move into an assisted living, or other options, whether you're going to move in with your family. Even then, you're going to need some help, and that help can be expensive if you don't plan for it. If one were to think that you're going to pay out of savings, your savings are going to run out really fast. So long-term care insurance, if you're lucky to have one, definitely keep it. And for those who doesn't have one, I mean, I always ask this question with the sons and the daughters of my clients. I tell them, hey, your parents were very smart. They have a long-term care insurance, but how about you guys? Have you thought about it? And 99% of the time I hear the answer, oh my God, I didn't even think about it. I mean, I always thought about dad and mom, but I never thought that I have to even plan for it. Actually, yes. I took for myself and my wife when I started this business, and I saw the details. I just couldn't resist it. I had to take it. Now, taking a long-term care insurance, you also have to have some idea about what are the parameters and how to choose those parameters. There is one parameter called the elimination period. Look at it like a copay. So let's say you choose a 30-day elimination period. What that means is, when it comes to the point that you're going to be eligible for the care, for the first 30 days, the amount of for the amount you're going to spend for the care comes out of your pocket. Whereas if it is a 10-day elimination period, then the first 10 days you're paying out of pocket, and from the 11th day onwards, the reimbursement for the care starts. Other parameters to keep in mind is you need to pick a dollar value for your daily maximum benefit. And don't choose a low number, because if you choose low numbers, your premium is going to be low, definitely. That's going to help you in the initial period. But when you're going to actually need the care, choosing a low daily maximum benefit is not going to be helpful at all. Try to choose a higher amount if you can manage the premium, what comes with it. It's always good to go with, by today's rate, I would say look for something in the range of 300 to 500, in that range per day, daily maximum benefits. There is another component called the inflation rider. What that means is, let's say you choose the daily maximum benefit of $500, and you choose an inflation rider of 5%. So next year, by this time, your daily maximum benefit goes up by 5%. And the year after, it goes up further by 5%. It's getting compounded over a period of time. Now, why this is important is, today when you take the policy, it's not something you're considering to use this policy anytime soon. Let's say you're in your 40s or 50s when you're taking this policy. God willing, you may not need to use this policy for another 20, 30 years. And if you're choosing $500 a day today, in 30 years, the $500 a day will almost mean nothing. So you had to choose a healthy inflation rider where the value of the daily maximum benefit proportionately keeps increasing.